Hello, everyone. My name is John Klaess. I'm with CMG Financial, and I've been in the mortgage finance business for 20 plus years. I've been with CMG Financial for 12 plus years. And one of the big reasons I wanted to go with CMG Financial is because the owner and the management team with CMG Financial is so active in new products. And I want to talk today about a product called the All-in-One Loan and what it can do to help your wealth building and what it can do financially and what it can do to the mortgages. And one of the people I have here with me today is Dave Herbst, who is the VP of financing for all of CMG on the All-in-One Loan product. So he's really an expert here. And welcome, Dave. I'm glad you could join me today to kind of explain the All-in-One Loan to people out there. As it's not a new product and it is gaining a lot of popularity, it's still, people have to understand there are different options in the mortgage. Wouldn't you think about, most people, all they think about is 30-year fix and what is my interest rate?
It's true. It's thanks for having me, John. I appreciate it. You're a class act, always have been, and I've known you for several years and enjoy working with you. And by the way, I think it's worth mentioning before we get started, you are actually one of the company's top all-in-one loan professionals, mortgage originators nationwide. So again, congratulations on another stellar year in 2021. And I know you've served a lot of people, not only with this loan, but a lot of other loans that are suitable for them. It's not a new product. We developed out this loan first under a different brand name, as you're familiar with, that we used to call the Home Ownership Accelerator. And that's really kind of the first rendition of this product between about 2005 and 2010. Still the same product. We rebranded it for a variety of different reasons. The All-in-One Loan as a brand name really helps reflect, what the product is, its structure, its origins. It's not a new product for us and certainly not new to the marketplace. But to your point, I do think it's still somewhat of a new concept for most Americans. I think that most people tend to just gravitate towards things that they already know, right? Things that they've been told are kind of the standard way to do things. Mortgages is probably one of those very stale areas where there hasn't been a lot of innovation. There's not been a lot of kind of creative thought. And I'm not talking about just, loosening up guidelines to allow more credit opportunities. Sometimes that's very good. Sometimes that's not so good. But what I'm really referring to is re-engineering how money is applied to the mortgage instrument so that it could actually, place the borrower further ahead. That would really, if we can do that, then that would really, benefit their housing goals and probably other areas of their, financial needs. And then that's what the All-in-One Loan, does. And it really changes the conversation. Again, to your point, we're kind of robotically programmed to really consider what's the rate first. And when you really dive deeper into that question, really the question beneath the question, what people are really driving towards is, hey, what's my payment going to be? Is this loan going to be affordable? Can I number one, get the financing I need to purchase a property or, maintain possession of the property I already own? But number two, what's the payment going to be? Can I afford that? Is it comfortable? Is it the lowest I can get? Right. And that's why people ask the interest rate question, because they're really driving at what's my payment and what is that going to be affordable? Is it agreeable? But that's only 1/3 of the entire equation. But when we ask people, what's more important to you, assuming that we're going to offer you a loan with an extremely low monthly payment obligation, right? That's of course, that's kind of built into what we want to provide, make it comfortable and affordable so that somebody can, has the ability to repay and manage their mortgage debt, wisely and comfortably over time. But again, if you ask people what's more important to them, the interest rate that comes with their loan or the amount of interest they have to pay on their loan, I guarantee you would get a different response. So the point here is that when you begin to go further than interest rate and talk more about what effectively leads into high interest cost, low rate mortgages still charge a high amount of interest over time. So we like to change the conversation away from just exclusively interest rate, knowing that the All-in-One Loan can supply a very low, sometimes way lower than a standard mortgage in terms of monthly affordability, but also is engineered to help reduce the total cost of the mortgage. And that helps people get out of debt sooner. And that's all what this loan is about.
Well, yeah, and explain a little bit about the innovation. We'll talk about the 30-year fixed mortgage and amortization type interest a little bit later, but explain the innovation of the checking account and the mortgage into one. And really, I feel doing this for a long time is one of the biggest assets of this loan is the principal pay down right away. Day one, you start paying principal first, whereas a regular mortgage is you pay interest first before you even get to start paying principal. It takes a long time to get those payments to equal.
Yeah.
So it's really explain a little bit how the all-in-one works and why it can save you interest over time.
Yeah, for sure. I like to kind of describe to people really and start from the start. I think the start of understanding the issue with traditional loans in America is really dissecting the payment structure. As you know, the payment structure with a regular loan, like a 30-year fixed or 15-year fixed. And again, John, just to caveat here, I'm not saying that these products aren't good, or suitable for specific reasons. They have their place in the lending industry. Potentially first-time home buyers and so on and so forth. They do provide some financial security, and of course, they're widely offered, so they have their place out there. The vast majority of people who owe a mortgage today or considering buying a home today are folks that tend to be cash flow positive and a bit disciplined with their finances. Of course they are, because they likely wouldn't be able to qualify for home ownership if they weren't. They have some financial stability, and sometimes when you're looking at getting a 30-year loan, the reason why people, I think, gravitate towards the longer term mortgage instruments is to reduce their monthly payment. It always comes back to that. The downside to that is that the longer you remain in debt, the more expensive that debt is to you. Borrowed money, and it's more and more and more expensive the longer you take to pay it back. In the best of worlds, you'd want to actually accelerate that process, get rid of it faster. You're not going to be charged as much interest on the debt, and you free up money. In a regular loan that's amortized, the payment structure is engineered in a way in which only a portion of your monthly payment goes towards paying down principal, and the other portion of it goes towards paying the lender's interest. And that's about 50% of the lender's interest is charged in the first third of a 30-year fixed term. So in the first 10 years, you're paying 50%, nearly 50% of the total interest cost. So you don't make very much progress towards paying down principal. So in a way, these mortgage products artificially keep your balance higher than necessary. The all-in-one loan solves that entirely. As you pointed out, it pays down principal first. It's just that simple. What if you could take the same amount that you're paying towards your mortgage today and instead apply that to the all-in-one loan? The difference is that on that mortgage, your principal balance reduces maybe by a couple $100, right? That month, as an example. And in the all-in-one loan, your mortgage balance reduces by that full amount. If your payment is $2,000 a month on your 30-year fixed and you refinanced into the all-in-one loan and you use that $2,000 towards the all-in-one loan, your principal balance reduces by $2,000 that day. And then what's great about it is it's engineered to recompute interest on a daily basis. So just the initial premise of paying principal down first, right, and not interest first, and having interest calculated separately. It's a separate event. It's only done after you manage your principal balance to help reduce the monthly amount that you have to pay in interest throughout the loan's term. So principal paid first is a very healthy way to pay and manage debt. Right. And I know I'm kind of summarizing here without getting too deep into the details yet. I imagine that's where you'd want to take the conversation next, is how it's structured and the innovation that makes that possible.
Yeah. One of the things, as you're talking about this, is it actually reduces your interest cost each and every month or each and every day, right, which is a very powerful, tool when you can reduce that on a daily basis.
Yeah. You don't control that with a regular mortgage, right? It's predetermined. It's part of the contract. And, again, there's maybe some security in that for some people, in some situations. Sure. But I would argue that the vast majority of Americans these days, especially as it relates to their finances, would like to take greater control of, the trajectory of their debt. Who wouldn't want to get rid of debt faster? Who wouldn't want to save time and money? Who wouldn't want greater opportunity to invest more aggressively sooner in their life? I think that people are really calling for something like that. And again, the innovation built into the all-in-one loan provides all of that.
And basically, is that through, because you hear people say, well, one thing I when talking to clients, I know if you're going to borrow $500,000, you're going to pay $500,000 back. It's how much interest has been charged during what you said is more the term. Is it 30 years? Can you reduce it to 10 years? But the all-in-one loan lets you kind of take control and timing of when you pay that back. You're not, you don't have to worry about, making extra payments, but then not being liquid and not being able to access those funds when you do make extra payment. Yeah. And then the other thing we'll talk about, I'm sure, is, people getting this refinancing or tend to do something different when their mortgage every 5 years or so, which, one of the things I really like about this loan, and I tell people, and it's more of an education because, obviously, us as mortgage people and loan officers would love to do a loan every 2 years, but this really should be the last loan you need on that specific house once you do get that loan, which is a powerful thing if people really look at the cost of what they spend on mortgages.
Yeah. I think due to the rigidity of loan instruments, right? And what I mean by that is they're not flexible instruments. They're very rigid. They're one-way tools, right? The standard mortgage that we use to finance a purchase or, maintain the majority of our mortgage debt. They're what's called a closed-ended mortgage, where money only flows in one way. You can't take money back out. In other words, if you make a payment on your 30-year fix today, you can't take that amount of money back out tomorrow. Maybe your hot water heater just broke, or you've got a leak in the roof and you need some extra cash. You can't take that back out of your mortgage, right? With a standard product. On our loan, the all-in-one loan is a two-way instrument. It's an open-ended mortgage, called a home equity line of credit. So that's really kind of the foundational, difference, is that this is a first lien position, 30-year draw. So it's a 30-year home equity line of credit. It allows you to freely put money into it to reduce your daily balance as well as your daily and monthly interest payments. And you can then pull those dollars right back out 24/7 over the 30-year term if you ever need. And it goes further than that too, John. It's, as you know, it actually comes with a linked checking account. And that checking account is designed to actually apply any of your deposits the day you make a deposit directly to your mortgage balance, your principal balance that day, reducing it by the deposit amount. And this makes a lot of sense for a variety of reasons. Most people will flow and manage more money through their checking account in just 5 years than they owe on their mortgage in America. And the problem with really the traditional way we manage our income and our debts is they're kept separate from each other. So you've got all this money that flows through our bank accounts over time. And you owe all this debt, right, on the other side of the coin, all this debt that's taken forever to pay off. You tend to pay a lot more interest and higher interest on your debts than you earn on your money that flows through a savings account or checking account. The all-in-one loan, thus the brand name, tethers those two together, your personal banking needs and your mortgage debt, into one consolidated instrument. Now it's using your deposits to pay down your daily balance, and it keeps your money free to use for bills and expenses as normal. And that's what accelerates the pay down, because you're just exposed to less and less and less interest on a monthly basis, as you previously pointed out. Yeah,
one of the things I like to bring up to people, who wouldn't really strive? Really, what a checking account is just a placeholder. It provides liquidity, but it doesn't really provide anything else. It doesn't really pay you any interest on that. It's really just a placeholder for you to do it, but it's comfort because it's liquid. Well, one of the things is realistically, if you want to maximize the efficiency of your money, because it is your money, it's money you've made, you've put in the bank. You'll explain a little bit why the banks like to use that. But really, if I could have that checking account at a zero balance every night, but knowing if I have a bill come against it, it's going to get paid no matter what. It's really the efficiency of my money and the flow of the money that really sets this loan apart from anything else out there. I believe it's it just really and the liquidity and control is fantastic.
You hit it on the head there. It's, you use the term zero balance, and I think that's probably a new term for a lot of people out there. Yes, you're right. Technically, the checking account, the all-in-one loan checking account, is what's called a zero balance sweep checking account. I love repeating that for people because it really helps describe what it's engineered to do. To your point, again, what good is your money sitting in your banking accounts, your checking accounts, besides just having secured access to your money, right? It's your hard-earned dollars. you needed a placeholder somewhere to securely to temporarily place those dollars so that you can spend and manage your bills and expenses and pay your mortgage payment from, right? Quite frankly. But if you think about it, money that we earn on payday isn't spent entirely the very next day. We don't spend all of our income on one singular day in the month for all of our expenses. The money you have earned already maybe is sitting idle waiting to be spent on your cell phone bill that's not due until 2 weeks, your utility bill that's due maybe in 10 days, maybe your real estate taxes that are due next quarter. A lot of times money kind of lingers and loiters around, for lack of a better way to put it, until it's needed to be spent, right? Including a mortgage payment. We kind of hoard that cash until we have to spend it. The beauty of the all-in-one loan and the checking account is that it's engineered to zero out nightly. It doesn't allow a balance to remain in the checking account. Instead, it pushes it. We call it a sweep. It sweeps the money automatically to the mortgage side of the all-in-one, which is a 30-year HELOC. So, and that applies 100% of your deposit directly to loan principal. And then again, remember, I said that interest recomputes nightly. It's actually at midnight nightly. It's simple interest. So the loan balance at midnight times the interest rate divided by 365 days gives that day's interest expense. And borrowers aren't charged that interest expense daily. We're not charged interest on interest. It's just computing simple interest nightly. And at the end of the month, each day's interest for the month is totaled up. And on the first of every single new month, customers will receive notification that their statement is available for them to download. You get this consolidated loan and checking account statement that shows you your line of credit amount, your limit that you can borrow back up to. You see your current daily balance. You also see the amount available to you to use that's liquid. That's the difference between your daily balance and the credit limit you were approved at. And you also see the cumulative daily interest from the month prior. And that's the interest payment, right, from the previous month. Even then, that interest payment isn't due until the 21st of that new month. So think about this, John. It's engineered, this zero balance checking account tied to the mortgage, tied to the HELOC, is engineered to keep even the amount of money you need to use to pay the interest payments in the all-in-one loan line of credit for an additional 20 days into the new month prior to having to be spent on the 21st. And what that does is it just continues to compound your daily reduction of interest cost each and every single month. And that's what accelerates payoff without any single budgetary change.
So, for an example, and you can kind of expand on this. So say I had a $500,000 loan and I deposited $10,000 into my checking account. That night, I don't use any, but it sweeps over, the balance goes to $490. But say I pay my bills through a credit card or something that I get rewards points on, that money can stay and work for me for that 20 days until I pay that credit card off. And that's really how you even more acceleration of this all-in-one loan.
Totally. You can take it further. And, we find a lot of people already do that already, right? They're using rewards cards out there to earn some benefit. And that delays the expense towards those items they're using their credit card, for to pay. So if you can do that, it really offsets, the amount of interest you're going to be charged on this loan even further. So, it takes basically the behavior and the banking kind of habits that people already have. And it puts all those dollars to work even further. It just enhances strategies like that.
One of the things I tell clients is, two things: you paid no interest on your credit card, but you got use of that money to save interest on your mortgage.
Effectively at the rate of the loan, right? So the interest rate on the all-in-one loan is competitive to traditional mortgages. So anytime you put money towards your all-in-one loan, you're using those dollars, if even for a day before you need to spend those dollars tomorrow. If even for a day, you're using them to save mortgage interest at the rate of the loan itself. So it's like a high-powered checking account that's serving to reduce your exposure to interest cost on your mortgage liability. And that's just a great thing for people. It's automated. It's gratifying. Every time you get paid, your balance drops by that amount, right? So it's a very just a very practical tool for people. And I think a lot of people need to know it exists clearly.
Do you have any information? And I know from my clients, and I've been doing this loan since its inception, because I really do think it is the the best mortgage product on the planet. But, on average, I see clients are paying their houses off 8, 9, 10 years type of thing, or at least reducing their principal by that. And, they stay with the loan. But on average, do you look at that, or have you looked at some of those numbers that we have?
We do. We analyze about every 12 months, sometimes 12 to 14 months. We analyze the previous year's performance of the what we call UPB, unpaid principal balance, of the entire portfolio of loans that are being serviced currently. And it's thousands, tens of thousands at over time. And as we analyze that data, really, we kind of categorize it in two separate ways. There's kind of a population of people that get this loan who perform exactly how you just described, where they get into it and through their banking behavior, they accelerate their pay down. And and that's because they're leaving more in the account than they're spending out of it, right? So they're accelerating it down. And the average pace of acceleration of principal repayment is about 13% per year. So imagine, your mortgage balance being eliminated, 13% or higher per year being completely eliminated. That's how fast it can pay down. And so imagine if you're able to do that, how much interest cost you could avoid, right? And again, avoiding interest on your mortgage means you're left with more money towards the loan. That's the thing that people, I think, need to, it's kind of a light bulb moment or statement. If last month I spent $1,000 in mortgage interest on my mortgage, and then this month I only spent $800 on interest on my mortgage, well, I've saved $200. Where will that $200 of savings be? Well, it remains in the all-in-one loan. It's available to me to pull out if I ever needed it for an expense. But if I was used to spending it, if I was okay spending that amount of money towards my mortgage, but now I'm able to save it, then I can just keep it in there. And as long as I keep it in there, next month's interest costs are going to reduce, as an example, from $800 down to $600. So again, now I'm creating not just $200 in savings. Now it's compounding. Now I'm creating $400 in savings. And again, that continues to snowball the effect every single month. That population of borrowers that get this loan pay down at that pace. It would equate into about a 8 to 11 year payoff right in there. That's the trajectory of their principal balance. I know people that have paid off their home in 2 years because of this. I know people that have paid off in 4 years, 5 years. Everybody's a little bit different. The average pace of balance reduction would have the majority of our customers paid off in about 9 to 11 years. The other population of borrowers that get this loan, we see the balance reduce dramatically, and sometimes we see it come back up. So, this is a home equity line of credit, and it provides access to not only the money you're using to pay down the balance, but also home equity dollars up to a certain limit. So sometimes people use this loan to leverage, right? To leverage and maybe invest or renovate or go buy another property. It's a phenomenal tool for a variety of different reasons, not just repayment and saving money, but also to, fund other financial needs along the way.
Well, I think it's one of the greatest financial tools you can use overall. And you sit with financial planners or advisors, they tend to agree. And let's talk a little bit about that opportunity cost. And really one of the biggest impediments towards retirement or creating wealth is interest you pay to someone else, interest that goes outside to someone else. That really creates an issue with, and let's face it, one of the problems right now we're facing is on saving enough for retirement. But talk a little bit about that opportunity cost and wealth creation that can come from this.
For sure. We of all the debts we service as consumers, right? Meaning of all the debts we have to pay for, we have to take on, right? In fact, let me step back just a second. We know that the vast majority of Americans need to borrow money in order to own real estate. I mean, I think it's just a truism. There are far more people who need to rely on, mortgage financing to buy a home or maintain possession of their current home than there are people with enough cash, readily available to just write a check and pay for a home outright. Thank God we all have access to the credit that we do in the United States, right? We do have a very fluid, credit market, and that helps us achieve our goals. But the reality is that over time, of all the things we have to borrow money for, and in order to, from college education for children to, from automobiles to, a mortgage, really, most of the middle class really cannot afford home ownership without, and other items without getting further and further into debt. So of all the things that we pay on in terms of debts each month, the mortgage is the biggest statistically. It consumes, about 45% of those dollars that we have to spend each month. So nearly half of all the money we spend on debt is actually going towards a mortgage. Then you start to break down the mortgage and you say, hold on a minute, what's the structure of the mortgage? Well, the mortgage, I have to borrow, a few $100,000. How much interest is going to come with that? And how soon do I have to pay that back? And can I control it? Well, the answer is no, you can't control it. And most of that interest is going to be paid for upfront by you. And you go, gosh, that doesn't sound like such a great deal. I guess is there any other choice? The all-in-one loan is an alternative. But I think what people do is they just subscribe to the idea that that's just the way it is. And so I'm going to try to get the lowest rate possible. Let me just map this out very quickly and make it easy to understand. Let's just take a $300,000, maybe a purchase price. You're buying a home for $300,000. I'll use that number. Maybe you're putting 20% down and you're financing $240,000, right? And if you were to get a 3% 30-year loan, that sounds very good. Maybe a low, comfortable payment. But the issue is the amount of interest you have to pay on that loan and how soon you have to pay it, right? And the structure of the payment. That loan actually would cost $52 in interest per every $100 that you borrow. $52 in interest for every $100 borrowed. Why can't we reduce that? Why can't we just restructure the loan? I mean, after all, loans are just a mathematical equation. It's a combination of interest rate, your balance, and the term or the time. So, as a lender, why can't we just restructure that equation? And we did. So that you can reduce the amount of interest you pay and that's a result of how money is applied to the principal balance. Why can't we reduce it from $52 in interest for every $100 borrowed down to maybe $22 in interest for every $100 borrowed? It puts customers in a better place. For the financial advisors and people working with financial advisors, that simply creates greater opportunities sooner in that customer's life to build wealth with. If you're spending less on interest, you have more money available to, build your wealth and financial security and independence with. It's just really that simple.
Yeah, I've always talked with my financial advisors thing. And one of the things, that kind of really people have to understand is saving interest is the same as earning interest. It's a yield. So it's one of those things that can be very powerful in the wealth creation on if you can lower your interest cost. I mean, one of the things, and again, we can talk about 30-year mortgage, which is a great product. It was designed so people could afford to live in the houses and buy in the houses. But there's not too many other places in your life, if you really look at it, even at 3%, you're still paying back 50% of the cost to borrow that. I mean, let's go further, John, is that, think about the example I just provided, $300,000 purchase price, and you put down your 20%, I'm just using this as an example, at a really low interest rate on, borrowed over 30 years to pay that back. Otherwise, that's a really good loan, especially, rates have come up a bit here recently. And so I think that people would look at that equation and go, gosh, that's a really outstanding loan. Don't change anything. Think about it this way. On day one, what that customer is doing is they're agreeing to pay a higher price than the home is actually worth presently, right? Yeah. So if the home is worth $300,000, the actual cost of the mortgage is going to increase the price of that home on day one by about 22%. So in other words, what other things do you go out and pay for on a daily basis and commit to pay 22% more than it's worth? That's what we do with mortgages. Now, the argument to that is, well, my home will go up in value over time, sure, more than the mortgage is costing me. And you go, okay, well, that's, of course, but we all hope that, that happens. And if there's any kind of softening in market value out there for homes, that doesn't occur when you're trying to retire. We don't control those things, let alone influence those things. So, but wouldn't it be great to not have to rely on those things that you don't control and don't even influence, but rather take control of the debt itself and just make your money go further? You're right. The amount of interest you save is earned because it's a yield to you, and you can either leave it in the loan and pay down as fast as you can or want to, or you can use a portion of those savings and begin to also, invest or renovate or improve your home and go fund other financial goals. And I think people desperately need that kind of cut in line. Yeah, yeah. And one of the things, I mean, I think it's just they say who is the loan right for? Well, there's many different scenarios who it's right for, but I have my theories, but let me hear what you think, because you do talk to many people over and you've helped engineer this product. So you really have an insight on who the loan works for and why it would work for them.
Just to give credit where credit's due, that, as you know, John, I've certainly worked hard to expand the product and expand its allowances and whatnot. I really love telling the story about our president and founder at CMG Financial, Christopher George, who really thought of this product and worked hard with our executive management team to engineer it, beginning in 2002 and get it off the ground in 2005. It's really something that he dreamt up after being exposed to similar products in other countries, specifically in Australia earlier that year in 2002. And he thought that it would be good for Americans as well, this type of financing, consolidated banking and borrowing in one place to better manage your debt and your idle cash. So, thank you, Chris George. I think it's something to kind of tout and be proud of. The best candidate for this product is a household or a borrower that is established with their finances, disciplined enough to know that they can't overspend, a good saver, somebody that tucks away money and is just kind of has the propensity to do that naturally over time and really target some financial goals. For those people that don't overspend, they don't overdraft in their checking accounts routinely, they're not super heavy users of credit, to supplement their lifestyle. Using credit's fine, right? In
Sure.
a lot of ways, it's required, right, here in the United States in order to build a credit profile and your borrowing power, right? So I'm not saying that credit is bad. What I'm saying is there are people out there that need to rely on their credit cards, don't really ever pay them off, and that's troublesome. And that customer would probably be much more suitable for a standard mortgage, right, where the costs are fixed. It's predictable, right? You know what you have to earn and pay each month. And on this loan, your earnings come in to reduce what you owe each month. So ongoingly, it's reducing your payments. To your question, people that tend to live within their means are disciplined that way, have some equity in their property, minimally 10, 20% equity in their home or down payment, do very, very well with this product. It's just surprising to them how fast their balance reduces. As you know, John, we also test suitability through our interactive simulator, our online calculator. And that is the best way for anybody out there that's interested in doing this. But as you know, it's a requirement in underwriting that calculator is used to stress test financial benefit compared to a traditional mortgage. We want to make sure that when people get this loan, they're going to be successful.
Yeah, one of the things with the simulator, it is a fantastic tool. And I would not do a loan for somebody who didn't spend time with me on the simulator to understand where their money's going in the financials. And some of the things on the simulator, which you can go to at the allinloan.com, it's open, but you want to do that with a professional like myself or like you to understand how to use it. But it also can show you the effective rate, which, talk a little bit about one of the great things about the simulator is it gives you timing and things like that, and you can play around with it, but it compares it to a 30-year fixed 3.5% loan.
Yeah. Yeah. You can compare ultimately really any type of mortgage product, conventional mortgage product, from 5/1 ARM to a 15-year fixed to a 30-year fixed. 9 out of 10 Americans actually have a 30-year loan on their mortgages. So it tends to be the gold standard, but the simulator can compare either a mortgage that's already in place for somebody where they may not be thinking that they want to, change it. You're having the conversation with them about the all-in-one loan as an alternative that would speed things up for them. It allows you to really go in and compare that existing mortgage at the point they're at already today. Maybe they're 2 years into it or 7 years into it or 10 years into their mortgage. And they want to see, if this loan would maybe accelerate things for them. It also could be used to compare a new loan that a conventional mortgage that a borrower is, considering. Maybe somebody wants to or needs to, take cash out of their home. So they're looking to another 30-year fix to achieve that goal, cash out refinance, or maybe somebody is in the market to buy a home. And so, you can compare what they would normally achieve with the 30-year fix on that home purchase versus how the all-in-one loan would perform. And so I think it's also at this point, important to point out that The all-in-one loan can be used for a refinance and a purchase, of course.
Yes.
Could also be applied to a primary residence, a secondary home, a vacation home, and also an investment property. So it can be used for all those occupancy types. A phenomenal tool for each and every single one of them. But the calculator is a financial analysis, very easy to run, but you're right. It's better served when ran with a financial expert, a mortgage professional who understands the loan and can really break down all the numbers and the math. It does display an effective interest rate. It's really kind of an effective APR compared to comparison interest rate. So it shows you what you would have to achieve for an interest rate on the conventional mortgage. Oftentimes we see that interest rate below 2%, sometimes even below 1%. So in other words, if you look at the analysis and you're like, man, in order to only spend this much money in interest cost, you would have to, the equivalent to that would be a 30-year fixed at 1.1%. That rate isn't possible, and still that wouldn't necessarily speed up the debt repayment, right? It's just kind of saying interest cost to interest cost. What would be the comparison effective interest rate on that? The simulator also shows a break-even interest rate, which shows you what rate would the all-in-one loan need to average throughout its entire time that you're carrying a balance in order to cost as much as the comparison loan. So it gives you those, guardrails and shows you, when this doesn't make sense for you and why, or why this makes a tremendous amount of sense for you and by how much. And then you could, of course, change some settings. You can save scenarios or simulations within the calculator and always come back to them and tweak them, and it's a dynamic tool that I think a lot of our customers enjoy coming back to even after they get the loan. It's not just a forecasting,
Correct.
during origination, right, during the application process, but even after they get the loan, it's really kind of a financial analysis tool they can fall back on and kind of look at as things change in their lives.
Yeah, one of the things, and I will be adding all my contact information to here below, and you'll be able to contact me, and I will be happy to go through the simulator with anybody on any type of scenarios. But one of the things, like I say, great financial tool. I get a lot of past clients call me and say, "Hey, John, I'm thinking of buying a new car. What are the advantages of financing that through the all-in-one tool versus going out and getting a lender?" Well, again, a lot of that, even if it's a 5-year loan, it's still amortized interest. So we teach them how to use the simple interest, which lowers the payment, and you take that extra money and it applies to the pay down of the loan, which can really shorten something like a 5-year to a 18-month type thing, which I found I work through with clients. The clients I stay connected to the clients all through the life of the loan with this loan. And it's really advantage to that.
Yeah. Anytime you're expensing money out of the all-in-one loan, it increases your principal balance. So instead of paying an additional loan payment on a car, as an example, $500 payment each month that you're sending out, there's a lot of potential benefit of not doing that, and instead consolidating that car loan into the all-in-one loan, so that you don't have to. Yes, your balance goes up by that purchase price of that car, but now you're not, that $500 you would normally have to take out of the loan, you get to keep in the loan, and 100% of that goes towards principal. So you're right. It's all about the conversion of how the payment is structured. The payment on all other loans, car loans, regular standard mortgages, you name it, are interest and principal, and it's amortized. We don't control how much of our payments goes towards interest or principal. On the all-in-one loan, 100% of what you applied towards it goes towards principal. So it offsets the amount of interest you're going to have to pay, rapidly accelerates the reduction of the balance itself. So that's it. It's actually a very simple and practical product. Explaining it can take a while, but I think people are, again, thirsty, very, very thirsty for some education and some innovation in finance, especially about mortgages.
And again, we don't have, and that's one of the things we do, or I do, and all CMG loan officers will do is kind of do an analysis over what your needs and make sure this is a suitable product. So it's one of those where we have to set up a call and do that. But one of the things, the great thing about this is like you said, it's the volume that runs through the checking account and how that checking account works. And at a later time, we will come up and we'll show the simulator and how the simulator works. But, again, it's a fantastic loan. for purchases or refinances, any loan amount. I mean, guidelines are up to 2 million, but sometimes we'll work on exceptions. But it's a great, and it doesn't change the features whether it's a $2 million loan or $100,000 loan. Yeah. And one of the things I guess is now a good time to talk about it is on the investment properties. So what I found, and you tell me, in this investment world, when you're trying to build real estate and do that, it's a lot about the cash flow and the access to the equity, the available equity, so you can keep purchasing products or properties if that's what you want to do. But the big thing is the cash flow on a monthly basis.
Real estate investors, I think, care about a couple things, really primarily. One is, I think that everybody would like a very loyal and respectful tenant, right, in their property.
Sure.
Whether it's short-term rental or long-term rental. I think having a phenomenal, renter is very valuable. Somebody that pays on time, right, each month. But I think also what real estate investors look for is to, create greater positive cash flow from that property, and if you think about it, and again, when I reference that, what I mean is the difference between your mortgage expense and what you're bringing in for rental income, right? So, in the past, I know a lot of people had to go negative on that number, right? Where the mortgage expense was higher than what they were bringing in rents. Rental market has grown; it's very strong, and people have been able to increase their rents, and rates have come down on mortgages, so they've been able to reduce their expense. But those are the two traditional ways and only ways that you can really create or generate greater positive cash flow from a rental property is by pulling one of those two levers or both those levers, raising rents and or refinancing to a lower payment. But again, you can't always increase rents. You don't want to price yourself out of the market. You don't want to scare away a very loyal and respectful renter sometimes. And you can't always refinance. Rates don't always perpetually go downward in order to help you save on your monthly payment. The other thing is that when you do that, you're offsetting, clearly the term of the loan. You're pushing the repayment back, and it's just charging you more interest over time. The all-in-one loan solves these things because you don't have to refinance. You don't have to chase interest rates. All you're doing is taking your rental income, flowing it directly into the all-in-one loan, which 100% of that goes towards principal, which then reduces the amount of interest payments that you have to make over time ongoingly. So month over month, your payments, your interest costs are reducing on this loan. The more you feed into it, the faster it reduces. And therefore, you don't have to rely on interest rates, moving downward. You don't have to rely on increasing your rents, right? And risk losing a great renter. Instead, you can just use a better tool that uses your money more efficiently to grow your positive cash flow in that real estate. And I would say number 3, you're liquid. You know what I mean? You're
Yes.
liquid. You
Yes.
can take money back out whenever you need to renovate the property, pay for a repair, and maybe even go invest in another property. It accelerates all that process and makes it much easier to do consolidated in one place.
Well, I know the two of us, we could sit here and talk hours upon hours about the all-in-one loan because of the opportunity and what it opens up for you. Taking up a lot of your time today. I hope we can do this again soon. But again, if you guys want to contact me, my name's John Klaess with CMG Financial. My contact information will be put below. And I want to thank our guest, Dave Herbst, the VP of Financing for the all-in-one loan with CMG Financial, for joining today. Dave, again, let's do this soon again, because there are many. I'd love to go through some scenarios of past clients that have done this loan.
Let's do that next. I think that's a very powerful thing, is to showcase, demonstrate the interactive simulator and what can be achieved just by consolidating your banking activity with your mortgage debt into one place. So anyway, John, I really appreciate the opportunity to be with you today, and look forward to our next one.